This is Saturday the 18th of October, and I've just been sitting here for the last few hours doing a bit of just looking through price action and making some observations, and there's a few things that was jumping out at me, so I figured I would make a video talking through them. These are ideas that I've been looking at for a while and have a basic framework around, but just while I was backtesting it today and looking for more examples, it kind of started jumping out to me more than ever. What it basically is, as you can see, I've got both these diagrams up. It's the second stage impulse rejection failure is the entry model, which is this entry over here. And this is a entry technique that forms within this framework. What this framework is when we have a retracement either from ERL to IRL or within a market maker model, I then classify that initial retracement as a smart money reversal, and then following that I look for the general market maker model framework to play out, which consists of first stage of the model and then following that second stage, each with their own characteristics. You can see I've got some order blocks marked out on here. That's not so important, but as an example of the characteristics of each stage, with first stage of the market maker model, there should be an intermediate term low or high, which is that low that's lower than the ones to the left and right. And then second stage, the characteristic is that the market will be in a fast movement. We'll have minimal to no retrace. We'll have signatures such as institutional order flow entry drill, propulsion blocks, and my impulse rejection failure. So basically a really fast price action, partial entries into fair value gaps. You want to see order blocks be very sensitive and result in a push. How this becomes useful is if you're able to recognize a retracement, which is pretty easy to do, wait for a shift, then recognize first stage, wait for another shift. All of a sudden you've had an enormous amount of time to recognize the structure building out, and then you can anticipate this part of the price action and find the nicest moves. And you can see that piece of the price action is this part here. Just need to change that a bit, and that results in this lovely leg down, but it's very fragile, so you can see it all over the place. You can see I've got this white dashed line drawn out both there and there as well, and that's representing this initial shift. So I'm going to move this to the side for now and then just talk through what I've got up on the screen here, and then I will go across and find many more examples. So initially what we have over here is we have a reversal, a leg lower, and then a retracement. So this is the first obvious retracement that hits a premium. Through this entire leg down on the higher time frames, this is all sell side delivery. Sure, internally there's small parts of buy side delivery, such as from there up to there, but in general it's all sell side delivery within retrace. So significant retracement, that puts in the smart money reversal, which is what I've got one. So ERL to IRL or retracement puts in the smart money reversal. After that we get that leg lower. So sure, this within itself is a market maker model, but this is extending that out and saying this is the reversal, and only after breaking this low then we look for first stage of the market maker model. So that's where shift comes in. Shift is number 2. That's when we break that retracement leg low. So we've had that shift. Following that, I want to see buy side delivery back up and to put in first stage of the market maker model. That becomes 3. So you can tell that we've got nice short-term high to the left, intermediate to the right, short-term to the right. So this becomes your first stage, and that is all confirms that that has played out. First stage is complete as soon as we break the low down here. So we've broken the low of first stage. That means that this stage of the market maker model is completed. After breaking that low, we can now look for second stage. Now, what are the characteristics of second stage? Well, minimal retracement, institutional order flow integral. You can see you've got a nice fair value gap right there that we just tap into, reaching the midpoint nicely, and then selling off. Propulsion blocks, you can also look at this, and if I zoom in a bit, I'm going to lose half this picture, but before I zoom in, retracement, expansion lower, breaks that retracement leg low, that's the shift, and then we look for first stage of the market maker model. Once that breaks that low down here, the first stage is now complete, and in this area right here, we're looking for second stage. How that looks is we have the low broken, a retracement that delivers buyer side delivery, so that's the key. It has to take out some sort of a short-term high on the left side of the curve, even if, like on the fractal level, that could even look like, you can see I've got the same pattern down here. It can be a really small short-term high, but it just has to deliver buyer side delivery, which means it has to take out a high on the way up, back above this level. We do that, we take out this short-term high, or we go into this fair value gap right here. After doing that, we break lower. Now, one of the characteristics, as I mentioned, is having that speed, that distance, those propulsion blocks, institutional order flow integral. And at this point, we can identify that, okay, we've had IOVD, we're rejecting lower. We can now anticipate this to hold as a propulsion block. And sure enough, it's very sensitive to price and shoots us lower. So that's a propulsion block right there. And then the second stage impulse rejection failure, I'll show what that looks like. This is a entry technique that I use where you identify a key swing low or key swing high. In this case, it is this previous day low, and that's simply because that is the low of first stage of the model. That low of the first stage of the model breaks the low, it retraces back above and delivers buy side into this fair value gap. We then close back below that low. As soon as we close back below that low, that becomes the entry signal on that closure, and then you just enter with a stop loss because this is fractal, like I typically put the stop loss above the swing high, but obviously on a smaller time frame you'll be able to refine that. But the stop loss simply goes up there, and then you expect a nice strong push low. And you can see that although it might have looked like a large stop loss at the time, it delivered the size move you'd expect for a second stage of a model quite nicely. I'll go over a few more examples really fast, and then you'll get a better idea of what I'm trying to explain. This is a much smaller example of it, but the exact same framework. So I'll grab those numbers again. And I should have done this a bit to start with, ideally. So I'll make a copy of all these and I'll number it out, but you can probably kind of identify what I'm looking at. We have a reversal up here, we drop lower, we have a market structure shift here, and then we have a retracement. So this is the first retracement after this market structure shift. So market structure shift, retracement. We can then put a 1 up here. We break that low quite nicely. That becomes a 2. That's the shift. I'll bring this back over. After shifting, we retrace and deliver buy side. For first stage, it's usually you'll see SMT here. Like I'd imagine that's likely SMT. Can't be bothered checking, but that's a lot of the time the case. After putting in first stage, as soon as we break that low, first stage is now complete right there. After first stage, what comes next is second stage of the market maker model. So we retrace, we have buy side delivery, taking out these highs. And then we break down below the low, we close below it right there. And that's where that would technically be your entry signal for a M1 IRF, impulse rejection failure, shorts there, and it makes a new leg down. That's sure, it didn't go very far, but that framework did play out on this small fractal. And there is a standard operating procedure for how to manage this trade that I'm implementing, and so far through my backtesting it seems to be quite effective. What that is once we have second stage, we make that low, we retrace, and then we close it back low. So this becomes that second stage low. Essentially, once we break this low again, it means second stage did successfully play out, which it always does. And once that's the case, then you want the model to continue pushing lower until you get out, because second stage is the last stage of the model, so you know that there's a reversal at some point in the future. Once we break that low, that counts as number one, so I just put a 1 there, and then I wait for the next low to form. It then retraces and then breaks that low. As soon as it breaks the low for the second time, that's when you want to go to break even. So if we have a stop loss up here, stop loss, and we get into our trade right there on that closure, so sell, price moves down a bit, it pulls back, so we've already broken the low once. After pulling back, we then break the low a second time, and as soon as we do that, you want to be locking in your gains, moving your stop into profit in case we get a reversal such as we do here. So now I will find a couple of more examples. We have here the 930 open. As this is part of a market maker model, a lot of the time just prior to that first stage, or the retracement at least, you will see a original consolidation. And there are a few characteristics of a original consolidation, one of which, the most obvious that everyone knows about, is when we have, for example, relatively equal lows, such as we do here. We have 1, 2, 3, 4, and even 5 relatively equal lows at the same place. But even more important than that, another signature is when you have multiple hourly open prices at the same level, which here we have 8 AM and 9 AM, indicating that this is a original consolidation. We then get that expansion away and then this retracement. So because this is the original consolidation that I've identified due to these opening prices, once we expand away and retrace, this becomes that first retracement, which means that if we grab these lines again, we can now mark this out as let's grab this diagram back, since this is even a bullish example, but this is now that same ERL to IRL retracement, that's this leg lower, and then we shift above this high here, so and a shift above that high. After that, we're looking for first stage, and in fact we have a very similar scenario here where we have a 1 hour low, this 1200 low right there gets run out. This becomes first stage, and then we run up. Now as soon as we break this high again, so I'll make that like that. First stage pulls back, we'll have SMD there most likely. We'll then break that high again, and what we're looking for, well, we're looking for second stage. As soon as we hit the high right there, confirms that first stage has completed, and now we want to catch second stage. But how low is going to go, where it's going to come from, well, you can use obviously any high time frame PD arrays. You'll find that this is a nice balanced range up in this area, and so you're buying in the upper portion of that or whatever. But rather than doing all that complicated stuff, I would simply use the impulse rejection failure, because one of the keys with this entry technique is if you try and use it down, let's say anywhere, like if you try and use it on this retracement here and then on at the first stage of the market model down here, you're probably going to get stopped out. Where it works, where it thrives, is when you can identify those fast moving times in the market, such as second stage of a market maker model. So if you can recognize this framework, original consolidation, retracement, smart money reversal from the retracement leg, smart money reversal, which if I'm losing all my diagrams and notes and things, but I'll just use these again. So consolidation, we have that retracement. After putting a retracement, this becomes the smart money reversal of that retracement leg. We then expand higher. We have number 2, which is that shift. After the shift, we then have first stage of the market maker model, which is number 3. So RTH, you just call it first stage. I actually adjusted that, I believe. So first stage, after putting in first stage, wait for that expansion out, and as soon as we hit the high right there, that now counts as the first stage having played out, and we're looking for second stage. How we capture second stage is either by buying a propulsion block, or you could use this breaker or anything, just any PD raise that would really hold price, or if you want to be ultra accurate and get a really high confirmation entry, you wait for us to deliver sell side, which means that we take out a short-term low of some kind. We do that right here. After taking out that low, we then want to closure back above that high. We get that right there, and then this becomes your entry. You can just buy there. I usually target to buy the midpoint between the close and the high, but it doesn't quite happen just there. Let's say you buy there, stop loss below the that low, and then this is second stage. And let's say using our logic with the stop loss, because it's the retracement, that means it's played out once, so this becomes number 1. If I do this, so 1, we make a high, we then start retracing, this becomes number 2. And as soon as we hit the high here, that's where you'd want to manage the trade, lock it all in, or at least, trail your stop up to demand that it continues in case it reverses. It could reverse from here, it could do anything. This is Friday, so no idea where it's going to be just yet. But yeah, in general, that is the idea. You'll be able to find it on, because the entire market moves in market maker framework ways, and there are a lot of different nuanced ways to identify, such as this one right here. You won't see people identify market maker model frameworks like this. Most people will be looking at, okay, well, this looks like a original consolidation, first stage, second stage, first stage, second stage, market maker model complete. Yes, that is a market maker model, but so is this original consolidation, first stage, second stage. So is this smart money reversal, first stage, second stage. There's just a lot of ways in which it does show up. Going over to gold real quick, because we've actually got a million examples over here. We have the same thing here. We have a reversal, make a low, retracement. So if we're retracing from this low, that can become our dashed line representing that retracement. We break that low there. This becomes first stage of the model. Once we break this low down here, that then becomes first stage having completed. We're then looking for buy side delivery, which we get as soon as we buy side delivery, taking out this high, closure back below that low, and then that becomes your entry signal. You'd enter at the midpoints between the two. And then looking for that leg lower, because this is the first break right there. So we have number 1. Hope you're following along with this, but it's the exact same sequence of events that I was writing about earlier. This is the second break off that low. And at this point, you'd be risk-free for the trade and see how far it wants to go, which happens to go to deep internal range liquidity. I did a very detailed markup of this chart earlier, which you can see the ruminants of, but I'm not going to go over any other stuff in this video. I'm only going to focus on this particular framework and sequence of events. But you can see this from my backtesting this morning. I'm going to replay this so we can see those hourly opens as well. Bit messy looking right now. What I'm looking at is how we have ERL right here. We have this intermediate term high that was broken, so it becomes us hitting ERL. After hitting ERL, we're looking for that retracement. We get a retracement here. We then break that high, that side of the retracement. That becomes our SMR and shift. Number 2 is that shift. We're then looking for number 3, which is the first stage of the market maker model. So retracement. We're now having first stage. As soon as we break that high that's out of the retracement leg, this high here, that's first stage is complete. We're now looking for second stage. For second stage, we need sell side delivery first and then a closure back above. Do we get sell side delivery here? Do we take out a short-term low? No, we do not. We hit the high, we trade below, but we do not take out any swing low. We continue pushing. So this is actually still just that same first stage expanding higher. Eventually we come back down, we deliver sell side, we get back below that old high nicely, and then we get a closure back above right in that candle. That becomes your second stage impulse rejection failure, and that is a valid entry. We then have a lot of other signatures that I'm looking at right now that really bring this home. But once again, we have that same original consolidation right before the retracement, so 1600 and 1800, then selling off, and we have a nice order block formation, which is in the form of the 1800 candle dropping down into here and taking out all the sell side. This is previous hourly candle low, expanding higher. After that, we then have 1900, a new hourly candle open. So the hourly candles, the hourly opens make a really good order blocks. Even though you can see all this price action in here, and sure you could refine it, it's down to, well, we've got this order block here, or we've got this breaker block right there. But still, just using those hourly opens is very effective. So if we using the hourly opens 1800, that is that order block. We respect the midpoint perfectly right there. Expand away from it. That confirms this order block. We're now looking for second stage. What does second stage go with? It goes with institutional order flow entry drill, propulsion blocks, impulse rejection failure, any fast moving markets entry techniques. You want to use those with impulse rejection with the second stage of the market maker model. Sorry, it's a mouthful. So 1900 hourly open, that becomes a propulsion block. Why? Because it dug into that previous order block. So we've got an order block with 1800, 1900 digs into that order block with 1, 2, 3 drives, becoming a propulsion block. As soon as we break out above that, this is going to be an extremely sensitive order block. The midpoint will act like a brick wall. We'd probably react right from the high. So when we drop into it, you can, 1, anticipate that we will not go past this point. And number 2, you can look for a reaction from that and really trust any move away from it. And you get that right here. This is one way to use the impulse rejection failure with the second stage. But at the same time, you can use it internally with this internal structure. This is a smart money reversal of this fractal market maker model. The same as this is a smart money reversal of this market maker model. However, you want to identify when the fractal that you're in is part of a higher time frame second stage market maker model, and then you can actually start using even more fractal entries, as well as, for example, we have second stage here, but also internally you have this market structure shift right here. And this is a trade I did take. I missed this one. I didn't actually see it at the time, but I did see this one right here where we have this impulse high that made the low. We break above it, we begin to reject lower, and then get a closure back above, and it becomes another entry right there. And another confluence for that is the fact that we had this manipulation closure as well, which I've been doing some studying on this weekend as well, and that ties into the market maker framework as well, because this is a bearish signature, but we're bullish, and that's why it's called a manipulation closure. But what this is indicating is actually that it is part of a original consolidation. I'll give a quick example of that. It is a bit of a side track. I didn't want to go too off topic, but if we go to the hourly time frame, we have, in fact, that's exactly what I wrote up there. You can pause that and read it if you want. I'm not going to read it through it now. But what it is we have a manipulation closure, which is a closure above the midpoint of this wick. That should be bullish, but it's the very next candle, it just rejects straight back down. That's what constitutes a manipulation closure. That becomes a original consolidation that we're planning on coming back to. We then come all the way back up, but this was actually just forming another failure swing before a larger pullback in market maker model framework. But what's interesting about this part is we look at this 4-hour candlestick chart over here. We draw out that same thing. This is that closure right there is this candle's closure right there. So this 4-hour candle closes, the 2200 4-hour candle closes right on that candle there. 2 a.m. opens up, new 4-hour candle, immediately sells off after having closed above the midpoint of the wick without taking the high. So this is the 4-hour doing the exact same thing that the 1 hour had done just prior. A manipulation closure, immediately rejecting, indicating an original consolidation. Once you see that, you can then drop down to those lower time frames and start identifying that same framework I talked about before. So that's that 1:45 a.m. closure right there. That's that 4-hour manipulation closure. Immediately we start pushing lower like that. And at this point you can start identifying, okay, well, I can see the manipulation closure. That's suggesting this is a original consolidation. And then you can start building onto that and looking for that market maker model framework from that point. And that's what I was showing on the low time frame before. We have the retracement, first stage, second stage, and then second stage sells off down to here. But then if you zoom out, you can then find on the high time frames, the high time frame fractals as well. Let's see if any more that I marked out. But it is essentially absolutely everywhere. It's just a matter of being able to identify it effectively. One of my favorite ways to identify it is actually on NASDAQ. I just haven't been trading NASDAQ much this week at all because, as I mentioned in an earlier video, for the first time ever, I am skipping New York session entirely and trading Asia and London. And for the first time in like 3 years, I'm awake during the daytime, which has actually been an absolute luxury. But I'll see if there's something that stands out that I can show you. But what I'm trying to get at is the fact that the easiest ones that make the most sense to me are when it happens right at the 9:30 open, and you have the same fractal playing out as we expand from the 9:30 open. I know there were a lot of examples the last few weeks. I just don't have the patience to painstakingly go through it. I think this is something that will work. So we have a reversal up here, a retracement. I'll put that dashed line down here. So retracement, we break that low. That now becomes that smart money reversal. So that's number one. Break the low, retrace again. That becomes first stage. First stage sells off. As soon as we break this low down here, first stage has successfully played out. And then we're looking for second stage. Second stage is when we retrace, deliver buy side delivery above this swing low, and then break down below that low again, and closure below this blue line. We certainly close below that blue line down here. It doesn't give us an entry just yet. Why? Because it's way too extended. When this is the case, what I do is I just go measure the midpoint between that closure, which is our entry signal, and the swing low that we were waiting to close below. And then I identify the midpoint. That becomes my entry. So entry is at the midpoint between those 2 points. Stop loss is above that failure swing from second stage. And then you're looking for that run low. And if you remember the break-even framework, is we have, after breaking that low for first stage, we retrace. This becomes that first swing low that we want to see broken. And once it's broken, that becomes number one. We're looking for the second one after that, which is this low. We then retrace. And as soon as we break this low, this is where you want to manage your risk, make sure that you're not, that if it does reverse, you're not going to get taken out. And so at this point, your stop would be brought down to break even. So your stop will be down here. And as you can see, it never got hit. And we continue just selling off and rolling over. And I'm sure there's probably other fractals of this model in here as well. Let's see if we can find anything. Reversal, retracement. Sometimes the market's just really strong and it might not pull back as hard as you'd expect. I mean, this is a very classic looking market maker model right here. Let's see what we can find. So we have this expansion. Oh, this is during the lunch hour, but it should still be there. But we have this expansion up. Is there a really obvious retracement in this league here? Nope. But what's this? This is a fairly obvious retracement after hitting ERL, which is that high just there, because intermediate term high, lower low, breaks it high, it becomes ERL once we hit it again, and so this becomes a retracement. So if this is the retracement from this high to this low, I'll mark out this. We're then waiting for that to get broken again. So that becomes number one, retracement SMR, breaks the high. And I'll put this on just so we can remember what it's actually called. So we've got number one down here, a retracement that puts in a reversal, breaks the high again, that becomes, and we're now looking for first stage, and we're drawing that line out there. First stage retraces, it breaks that high again, so that becomes number two is that shift. Number three is when we put in that smart money reversal down here, well, the first stage, sorry, we put in first stage of the market maker model. Three, we then break that high again, and that completes first stage has now played out. So retracement, first stage, and as soon as we do that, we're then looking for sell side delivery. We don't get it yet. We now have taken out a swing low, check. We then get a closure back above right there. So number four, and let's see if we get stopped out on this or if we can trail our stop. So we'd be buying right there. Stop loss will be going below this failure swing for second stage of the market maker model. We're then looking for after, so I need to see what I'm actually looking at. So that's that high from the retracement. So this becomes number 1. So number 1, we break that high once. We then deliver sell side there. We then break that high a second time right here. So it's very tight as you can see, but we did deliver sell side, broke that high a second time. That becomes number 2. And as soon as we break that high there, you want to manage risk. So if you went break even, you'd be moving your stop up to right there, which you can see it falls just a tick short of, and then has this rip up and reverses. This is why you use this standard operating procedure for managing your trades, because second stage is the final stage of the market maker model. So sure, it could have a really big rip, but also it could just have a little pop and then reverse on you. And let's see if we can find this exact same fractal here. Reversal, we have a market structure shift. Retracement, so I'm going to use the same line to mark out that low of the retracement leg. This is a retracement, smart money reversal. We then break the low. Only just break it, we didn't close below it, so let's see how that plays into things. But breaking that low, let's say we call this first stage, breaks the low again. We don't deliver buy side just yet, so we have to wait for buy side to be delivered, but we create a little short-term high, continue drop lower. Now we've delivered buy side because this run up here took out that short-term high. Buy side delivered, we then close back below that low. So that becomes your entry signal on that closure. And because we closed quite a bit below the low, let's say we used the midpoint, we probably would have got in on that next candle. If not, we would have got in there. Your stop loss goes above that second stage high. Doesn't take it out, it comes extremely close, but it does still survive. And because that's the retracement, we broke the low once here, so that becomes our number 1. And then number 2 obviously is just going to be that. And at this point should be a break even or better, and then you get that leg low. And you can see this time it actually does get a nice move low. So we just twice in a row identifies that retracement after doing an ERL just here. After retracement, we classify this as the smart money reversal, expansion, first stage, second stage, reversal. Shift, retracement, broke the low, so another shift, first stage, breaks that low, second stage on the closure below, using the IRF entry technique, and pushes low. And then obviously if you don't want to use this entry technique, you can use any other PD array. You can say this is a propulsion block because this is, we're looking for that first stage, the second stage, or institutional order flow entry drill, whatever you're looking for. And that becomes what that is. We'll try and see if we've got the same thing here. Now this becomes, it looks very similar to the other example where we have a retracement. So we have the reversal up here, obviously. This is the first retracement, pulls all the way back up into a premium of this range. And then after that, what we're looking for, I'll grab out these numbers again. So retracement is number 1. Number 2 is we get that shift below that retracement leg low, which is right here. Number 3 is we're looking for first stage. First stage will have an intermediate term high, which we get right here. So clearly we got a nice first stage of the market maker model just here. After making first stage, we then break this low. And now we're looking for second stage. Retraces, And right here you can see it just continues pushing down really aggressively and hits sell side. So potentially this on a fractal you'd be able to guess in, or just trusting that this propulsion block would hold because it did take out the swing high just there. Let's see. Yeah, so right here you can see it's getting really tight, but the same kind of framework is still playing out. It's just a lot tighter in the way that it does it, and we don't get a candle closure before it sells off. Like if it had closed right there and then sold off, then you would have got an entry, but in this particular case it was just too fast and it's immediately hit all the sell side. Just going to replay this as well so we can look at the hourly open prices as well, see if we can identify anything. Well, we can see what looks like a original consolidation down here. We have two opening prices at the same kind of area. You also notice how it's quite a consolidatory type of area. Get expansion away, and then you're looking for that first stage and second stage. But yeah, while I'm talking through all this area, like I'm sure I'm focusing on just this, but when you look at the bigger picture, this becomes first stage, original consolidation. This becomes first stage. This becomes second stage, but within that, we've also got first stage and second stage. And so it becomes infinitely fractal. And that's why if you have a high enough time frame, like if you identify a daily market maker model and you identify a second stage of that model, then identify a fractal 1 hour, and then identify a fractal 5 minute. And then within the 5 minutes, you zoom in, you're like, okay, well, now we've got that shift, that's intermediate term low, and then you're able to find an entry like that. You can capture a second stage on the daily time frame, but on a really, really fractal time frame. And that's only really possible as well when you're using time of day to your advantage. So knowing that, okay, when we have these massive moves that move the daily charts, like a second stage in a daily time frame, you're going to find that this exact entry technique probably showed up right at 9:30 a.m. And that's a way that you'd be able to leverage this to an enormous degree. But yeah, now I'm beginning to slow down, beginning to get a bit tired, so I will call it right there. But yeah, there was just a observation I was having before, and it was just jumping off the chart, so good to get a few extra reps in. And yeah, hopefully be able to implement it in a bit more of a fluid fashion. Because I've got a way of naming every single move in the market, but that hasn't got me to where I want to be with my trading just yet. So I need to work on having all these nuances and confluences and things in the back of my mind, but being more action taking and just fluid in my approach. If I'm trying to just name everything in the marketplace constantly, like sure, I can be very specific of what I'm looking for, but it's also going to result in a lot more difficulty just trading in general and staying in a good emotional and psychological space while trading, versus just having a general understanding of how the market moves, but not over analyzing as such. There's a meme that I found a while back that I really relate to and I think is incredibly true. I'll paste it here. But this to me, I think sums up the best traders versus the worst. The best traders is literally that. It's long or short. It's just, if it's a buy, I'm going to buy it. If it's a short, I'm going to sell it. And that's how you do it. But on the other hand, if you're going, okay, well, I think it's going to go to this high because it's got a this wick that's this length, and then it's got these highs down there, and we've just taken out this original consolidation. We've got a first stage here. This is a IFEG first stage, second stage entry technique with an order block and reversed 69 bathtub entry, and then you're trying to zoom in and go, okay, now I need to find my entry. You buy at the impulse low, and if it goes down there, then it's probably a short, but if it doesn't, then it's probably a long. And so I'm going to get in here, and then I'm going to target 5R. All of that is going to completely wear you out, and you're going to miss the easy big picture, which is, okay, is price going up or down? Price is going up. Cool, I'm going to buy a pullback. And you just buy the pullback and catch a run up. Sure, you need a bit of like more nuanced details and stuff, and to have a structured way of looking at it. But once you have all that nuance understood, that's where it becomes part of your intuition, and no longer, like, you'll find that this guy right here, he studies all this Fibonacci stuff and Elliott wave theory and order flow and IZT and everything, but he no longer like looks at it and goes, okay, this is the Elliott wave A, B, C, D, and now here's our inversion fair value gap, and here's our Fibonacci 63% retrace. He's no longer looking at that. He just intuitively knows what that is. He's seen it enough times that now he's just focused on buying or selling. And then that's where all that back work of being in this stage, where you are learning all this stuff and doing all this more complicated stuff, that does come in useful, but only once you stop using it. So you need to understand it, but then once you understand it, you can let it go, and then trading should be easy because your brain's done all the work. Like, your subconscious mind is doing the work for you. But you have to first develop that subconscious understanding of price. So this is where I want to get to. I actually want to print this out and put it on my wall, because it really represents that ease and easiness of trading, and which is where you get to if you want to do really good. There's a quick poster that I made that I'd also like to share. I made this, I put it up on my wall as well, and this is kind of representing the same idea of this. Rather than having a really complicated thing and saying, okay, I have to not go and tilt, I have to not do this, I have to be better, okay, better risk management and things, and just over-analyzing and over-stressing about all these little things. Just have a really simple, easy, laid-back, basic approach. I just have good risk management, I take good trades, and I execute like a pro. It's easy. Then money comes to me. If you can have that kind of approach, you're no longer striving to achieve something. Because if you are striving to achieve something, like, I need to have better risk management, I have to be patient, I need to not go and tilt, all that implies is that you don't have good risk management, you take bad trades, and you go on tilt. So if you are striving for something, it means that you have a lack of it. That can go to material things, and also all these other areas of your life and psychological things as well. If you're striving for something, it means you don't have it. If you aren't striving for it, you're just living in that experience of being where you want to be. I want to be at the point where this is normal. This guy right here isn't thinking about how he has to try really hard to not go on tilt, and he has to hold his winners longer because he's not good enough if he doesn't. He just does it. It's just what he does. It comes naturally to him. That's obviously something he's had to develop over time. But if you want to become like this picture where you're not striving to not go on tilt, and not striving to have more patience and things, you need to come from an approach of not having a lack of that, but being in his shoes already. So he's just the kind of person who doesn't do that. It's just not really even in the picture. It's not even a thought that comes to his mind. So I feel like this poster really embodies that, with have good risk management, take good trades, execute like a pro. Nice and simple, and it just gives that really easy feeling of being there and not striving for something, but having achieved or knowing what you are, like what your reality is. So yeah, that'll do for this video. Hopefully that was insightful. And I do recommend studying market maker model frameworks quite a bit. The really basic way to look at it is simply just look for a intermediate term low, and then a institutional order flow integral. So that's just a lower low, first stage, and then an IFD, second stage. That's a market maker model framework, and then obviously before that you have a original consolidation, and then that becomes your market maker model. Then if you just copy that exact same thing to the other side of the curve, you have the same thing. That's first stage in alignment with second stage of the left side of the curve, breaks lower, IFD, and there you go. That's your complete classic market maker model. But within that, you have that first stage, second stage framework, original consolidation, and then you have that retracement, breaks the low, first stage, second stage. So it all lines up, and I do recommend just studying that kind of thing because it ties in nicely to knowing what trades to find at what place. Like, is an order block going to work here? Is a fair value gap going to hold here? Should I expect a deep retracement or shallow? That's what that's going to tell you. So yeah, that'll do for now. Have an epic week next week if that's when you're trading. Sure.